Good morning, everybody. Today's topic is break-even point analysis, that is cost, volume, and profit. Why this big name is like this? Profit depends on how much you sell. That means the volume. Profit also depends on cost. Break-even point is the point when all your costs are met, meaning you make no profit, no loss, just recover all the expenses. So that is the topic today. In the next two sessions, today and the next session, we're going to cover relation between cost volume, then what is break-even point, advantages, disadvantages, margin of safety is another very important topic, operating and financial leverage, cost indifference point. We'll be discussing all of that. Now, this is part of a mega subject. The subject title is managerial accounting. And cost, volume, profit analysis is a small chapter in managerial accounting. So we are just covering a small part of that because managerial accounting involves many topics like budgeting, trend analysis, forecasting, then management of account receivable, constraint, inventory management, financial leverage metrics, cash flow, product costing, and volume. More importantly, it consists of demand supply analysis, then cost of production analysis, inventory management, advertisement, meaning why you do all of that, how you decide whether to advertise or not. Because, for example, inventory management. If you are a manufacturing company, then you buy material, keep them in stock because you want to ensure that supply is always there, meaning the production is never affected due to shortage of supply, shortage of raw material. But then how much is good enough, how much is too much, that also is to be decided, because anything that you buy requires money, nothing comes free. And even if you have some money, if you are trying to procure a lot of stock in order to ensure that you never run out of raw material, you will find that it's consuming so much of money. Money matters too much in business. In fact, money matters the most in business, because if you do not have enough money in your pocket, you will end up borrowing money. And if you borrow money, you have to pay interest. And this is a significant component of cost for majority of the companies. You know, I talked about Bhushan Steel, SR Steel. Bhushan Steel borrowed something like 1 lakh crore rupees in order to maintain their inventory, for meeting capital expenses. So 1 lakh crore rupees comes with something like, say, 15,000 crore rupees of interest annually, or maybe 20,000 crore rupees. And such a company makes a profit of what? Maybe something like 5,000 crore rupees, 10,000 crore rupees, but interest itself is about 15, 20,000 crore rupees. Obviously, these companies could not sustain. Same story with SR Steel. They could not sustain the interest cost, and eventually they had to fall sick. And then Bhushan Steel was taken over by Tata Steel, and SR Steel was taken over by Mittal Group of UK. ArcelorMittal is the company name, flagship of the Mittal Group company. So they took over that company by paying close to 55,000 crore rupees. So bank lost something like 50,000 crore rupees of loan that they gave to these companies. So all this happened because of interest. And that is why you should be very careful about managing your assets so that you don't end up borrowing too much money. Say you are running any kind of, say you are running a plastic pen manufacturing company. Now you have to maintain a stock of plastic granules. This is maybe polypropylene, polyethylene, or HDPE or something. So you buy those granules and keep stock because you want to ensure that everyday production is never hampered. So for every ton of plastic, you will end up paying something like 1 lakh rupees. So you need to have that 1 lakh rupees. Then whatever pens you have already manufactured, suppose you have manufactured something like another 1 lakh pen, which is standing somewhere in the inventory, maybe in the finished goods stockyard. So there also maybe you have already invested maybe 5 crore rupees in that. Similarly, the goods in process, meaning the pens that are being manufactured. Maybe that is small, maybe 50,000 rupees or maybe 10,000 rupees. So all these money together, it will add up to something like 10,000, sorry, 10 crore, 10 lakh rupees or so, just to manage a small pen manufacturing company. Now, suppose you have invested only 2 lakh rupees, you have borrowed 8 lakh rupees. Now, suppose with some magic, you can now manage the inventory in a manner that you don't need 1 lakh rupees worth of inventory. You manage only with 50, say 20,000 rupees worth of inventory, and finished goods also, whatever you produce, you just push it to the retailer or maybe wholesaler, so that there's no inventory buildup. Eventually, you will be managing the inventory so well that instead of 10 lakh rupees, now you will need only 2 lakh rupees. So you will save interest on 8 lakh rupees, which will be something like, say, if the interest rate is even 20, most of the cases it is either 10, 15 or 20. If it is 20%, 1,60,000 rupees will be saved in the year. So making an investment of only 2 lakh rupees and without borrowing any money, if you can manage, you save 1,60,000 rupees in a year. So that's a huge saving. On the contrary, if you borrow 10 lakh rupees, lavishly maintain your inventory, then you end up losing 1,60,000 rupees every year. Your investment is only 2 lakh. So obviously your objective is to manage the inventory, and managing inventory, there are tools, there are methodologies which are discussed in managerial economics. We are not going to discuss that. Neither cost nor advertisement. Advertisement requires money. Suppose you target some kind of a profit, that we want to achieve this amount of profit. Profit comes from sales. So you have to achieve certain amount of sales depending on your profit target. How you achieve that sales? You cannot just go to market and people will buy. That will never happen. You have to make people aware, and everything requires money. Whatever you would like to do requires money. So advertisement is related to sales, related to advertisement. Advertisement is related to cost. You have to spend money. So eventually, whether there will be any profit left, particularly whether you have the money to advertise, that is number one. Number two, whether this is going to translate into profit or not, that will depend on the cost of advertisement, the media that you choose, etc., etc. Similarly, pricing decision. Suppose you have a sales target. Now you go to market to find that competitors are selling at a lower price, or maybe they're selling at a higher price, whatever. But if you want to enter into that market, you cannot sustain that price, or you have to have higher price to ensure profit. So pricing decision is again a huge decision in business. That is also covered in managerial economics. Similarly, profit management. Everything boils down to profit management. So whatever I have discussed so far all are subsumed into profit management. Capital management. Suppose you want to put up some automatic plant or maybe labor intensive plant. How much money is necessary? Where do you make more profit? Where you make less profit? How much capital? What is the interest cost? All of that are part of capital management, which is also obviously is a very important subject. Now, these topics are not part of our next course of discussion, but you should know what are the topics that are there in managerial economics and where to find these courses. At least if you are interested, then you will lay your hands on a book that is within managerial economics. In fact, one single book in managerial economics will give you all the topics that are there here. Now we'll just touch upon the demand supply, not even forecasting. Demand and supply. Price and quantity supplied are related to demand and supply. Suppose market doesn't have demand, then price will come down, and the quantity that will be available, meaning the supply, also will come down gradually, because price has huge influence on supply and price has huge influence on demand. If tomorrow the demand goes up, price automatically goes up. If tomorrow, suppose another new plant comes up, so supply goes up, then price automatically comes down, because more number of companies are targeting a constant number of people to buy their goods, so they will always reduce the price to make their product more attractive. Now suppose for whatever reason demand goes up, maybe people's income has gone up, and or maybe for whatever reason demand has gone up, maybe lifestyle has changed and the kind of product that you are selling is being demanded by more and more people. So when demand goes up, suppose demand and supply, this is called equilibrium price, where they intersect, wherever they intersect is called equilibrium price. So this is the equilibrium price, and only this amount of quantity will be demanded at this price. If demand and supply doesn't change under this situation, the price will be this and quantity supplied will be this. Now suppose demand goes up for whatever reason. Now if the supply doesn't change, price will tend to go up because people are demanding more product. So, or if the price has to remain constant, your supply has to, quantity supplied has to go up. In that case, price may remain constant. If the supply doesn't go up, whereas the demand goes up, then price will automatically shoot up. So that is the situation of monopoly. Say one company is manufacturing only one product, and then no other company is manufacturing, and suddenly demand goes up, the company is sure to increase the price. So you need to understand the market structure and elasticity of demand, meaning whether if I increase the price, will the demand be affected? Will people shift to some other company, some other product? So depending on elasticity means how it responds to an stimulation. Suppose you increase the price. If the demand doesn't change for something like essential items, say for example, COVID vaccine. Now suppose the vaccine price is 250 rupees a shot. Now the companies think that people have no other choice but to buy this, and more people start demanding. So they might very well increase the price to maybe from 250 to 500 to 1000 to anything. As long as there is demand, they will keep on experimenting with higher price unless government intervenes and then they restrict them from increasing the price. So elasticity means whether that is called inelastic demand, when people are, when the demand is not affected by price change, that is inelastic. Suppose there are similarly, say same thing, say COVID vaccine, they reduce the price. It's not that there will be too much of demand, because there may or may not be. Like poor people will try to afford that, so there may be initially some increase in demand, but as soon as the demand is met, even if you reduce the price, the demand may not be higher. You make it 5 rupees also, people, suppose there is no COVID or everybody is vaccinated, then there will be no demand. Then also demand becomes price inelastic. Now suppose supply goes up, meaning you suddenly a new company comes up and then they also start selling. So the moment supply will go up at the same price, the demand at the there may be two situations. One, suppose demand doesn't go up, demand remains the same and supply is more. So people will, the price will automatically come down. Here it was here, the demand or price was here. Now for the same quantity, or for the same this was here, price has gone up, or supply has gone up. So at the same price, price actually will come down. What I said, supply goes up. Supply goes up meaning there are too much quantity in the market, so price should come down. Demand is the same. Supply goes up means price will come down. It's not, maybe not properly depicted. I'll think over it. I don't want to spend time. Similarly, suppose supply goes down, supply may go up, supply may go down, demand may go up, demand may go down. Eventually, suppose demand and supply both goes up, then the quantity will be higher at the same price. That's the message. Meaning, suppose people can afford more, and companies, in response to higher demand, they have increased the supply, so price will remain the same at meaning at higher demand and higher supply. So quantity goes up, price remains the same. Likewise, just an overview. I never wanted to actually, I have just added these slides right now, just before the class. I was just doing it. So it's just an overview, demand, supply, elasticity and all that. is a huge subject. That should be a full one class. I used to take that class earlier, but now the topics have increased, so it's no longer viable to go into depth of that. Now the main topic is break-even point. Break-even point, as I said, is a point when your total cost or total expenses is exactly equals to the total sales. That means that is a level of production and sell when you meet all your expenses. That is a very important metric. Why? Because suppose you have 5 different business opportunities. Now you want to know at which cells all the businesses are separately breaking even. Say for business 1, break even is at say 50,000 units. For business 2, break even is at 60,000 units. For business 3, break even is at 70,000 units. So maybe chances are that you will like to go for a business where break even point is at a lower level. But that will depend on many other factors. It's not a straightforward decision. We are going to talk about the price indifference point. That is very important. So only after discussing price indifference point, you will be able to make a holistic decision. Even then it's not holistic, but more holistic decisions. So that's very important that you know where the break-even point is. Suppose let us remain on that pen example. Suppose you are manufacturing plastic pens, say dot pen or maybe a gel pen. Now you have 2 options. You have many options actually. Let us discuss 2 options. One is manual press or compression molding machine. Compression molding machine, meaning you put the plastic granules inside a cylinder, and then a person will push a handle and a plastic component, a pen component will come out. It requires some time, some human involvement, and maybe in a minute you'll be making something like 10 pens, perhaps 10 complete pens. This is one alternative, and you can put maybe say 20 such machines, and then your productivity will be, say, if it is say 1,000 pen per machine, it will be 20,000 pens per machine. That is one option. You may have another option to buy a semi-automatic machine. Just one machine will manufacture 20,000 pens in a day, and there is only one lever involved to operate this machine, and there will be whatever automation will come with little bit of a more maintenance, but then you need a less space, so rent also will go down because you don't have to install 20 machines, etc., etc. So you can see that 2 machines, two constructs or 2 different contexts have 2 very different cost structure. So in one machine, suppose your break-even point is at say 20,000. And in the automatic machines, a manual machine, break-even is 20,000. On the automatic machine, suppose the break-even is 30,000. Why 30,000? Because now you have to borrow money, because automatic machines are going to cost you a fortune. And you need air-conditioned room maybe because it's computer controlled. So etc., etc. So there are so many parameters. So your capital cost will go up. So interest expenses will be very high. That is why perhaps break-even point is higher. Now you have to think whether to buy an automatic machine or whether to install labor-intensive low-tech machine. Now you may have different perspective about making profit, about productivity. So considering many of the things, you will make a decision whether to go for a setup with lower break-even point or to go up with a setup for higher break-even point. So this kind of decisions moving forward, meaning more mature decisions, will be depending on very basic information like break-even point. There will be more other metrics that are going to give you more handle about this, but then this is very important to understand where do we break even for selection of business models, different business models. We are coming to that more gradually. So you want to maximize profit. Now for profit, you have to sell certain volume of products. And for selling those volume of products, you're going to incur some cost. So sales minus cost is the profit, as simple as that. Now to give you a more complex perspective on profitability, let me show you more elaborately. Your objective function is maximizing the profit, increase your profit. Now profit is a percentage of sales. To increase profit, you need higher sales. That means you have to increase the sales. Alternately, you can increase price for same sales. If the price is increased, profit will go up. But then how can you increase sale price? It's so simple to think. But the moment you increase the price by 1%, you will find immediately more than 1% of the customers are already running away. They are switching to competitors' product. So obviously you don't want that. You don't want that customers should go away. So you cannot increase the price just like that. Or reduce the cost. That is another way of making profit. But how to reduce? You cannot reduce just by wishing. You have to reduce by lowering your raw material cost, or that depends on your supplier. Supplier will say nothing doing. I'm going to increase the price, increase your cost. So it's a huge catch-22 situation. Then you may advertise without increasing the price, without increasing the reducing the cost. You can make more sales without even increasing the price, your price, by advertisement. But then advertisement cost comes with cost. So how much should be good enough for achieving that sales, and is the profit more than the advertisement cost that you incur? So this is a huge decision that you have to make. If you ignore this slide, this is incomplete. So let me put it in presentation mode. Okay, so that is why we say cost, volume, price analysis. But then there are two kinds of cost that helps us to do the break-even analysis by bifurcating all the costs into two components. One is fixed cost, another is variable cost. And that becomes the total cost. That means we are bifurcating total cost into fixed cost and variable cost in order to estimate break-even point. That is how the formula has been devised, etc., etc. What is this? So nothing big about it. Meaning, I just wanted to say that this is your sales. The large one is the sales. From there, you eliminate the fixed cost, eliminate the variable cost, and you get profit. That's very naive, not a very intelligent way of showing. Now, relation between cost, volume, profit analysis. That is how the title of today's class is. I have already discussed all of that. You just read them. There's nothing new about it. Cost and cost drivers. Cost drivers is very important. Construct, you need to understand that. Suppose you are manufacturing the plastic pens that I told you. Now, plastic pen is not everything about plastic. You need a clip that is metallic. You need the nib or whatever that is maybe metallic or maybe some other kind of plastic, but there is a ball that is definitely metallic. Then there is ink inside. So many things are involved. So everything that adds to cost to the pen is a cost driver. I have only discussed about the raw material part of the cost. Now, suppose you want to manufacture the pen. Now, who is going to manufacture? You are not going to manufacture. Some laborer will be manufacturing. So you want to manufacture, say, 1,000 pens a day by one laborer. So for manufacturing 1,000 pens, you have to pay 500 rupees to one laborer. Now you want to manufacture 2,000 pens, you have to pay another 500 rupees to another laborer to operate another machines. So that is another cost driver, because that 500 rupees is adding to the cost of your pens. Likewise, you have to pay rent. You have one machine. Now you want to put 10 machines. You need bigger accommodation, bigger room. So obviously you are going to end up paying more rent. Rent is a cost driver. Power, you consume electricity. So that is another cost driver, because these are all adding to the total cost of the product. Same thing, talked with different example, maybe a plastic bucket, the same thing, maybe a restaurant, the same thing. Whatever you have to add to your menu or to the finished product, if that is going to involve cost, that is a cost driver. So we need to understand cost driver with the view to have a control over that cost. Suppose I talk about plastic pens, and plastic is a cost driver. Now you think that this cost is too high. Can I reduce this cost to increase profit? Now you see how can you reduce plus total plastic requirement is the same, but then there is always a possibility. For everything there is a possibility, so you have to think hard to find that solution. Now plastics are of different kinds. One is polypropylene, then polyethylene, polyethylene terephthalate, that is another thing. Say high density polyethylene, HDPE. Likewise, there are many kinds of plastic. Even PVC is another plastic. Now you have to see what is giving you best quality and what is its price. Now another way of reducing price of plastic is to buy in bulk, but then that is going to cost you that is going to involve interest cost, because if you want to buy in bulk you need more money. Suppose you are buying only say 500 kilogram of plastic per day, and not per day, at one go. So next day you find that still I have plastic, so I don't have to buy. Third day you see that plastic granules are coming down, and tomorrow you need another to replenish. So you will be ordering, then tomorrow morning that plastic will come. It's almost like just-in-time maintenance of inventory of raw material, but then you may maintain that way. If you do that, then the guy will say your cost is 110 rupees per kilogram. Now you tell him that no, you are selling for 1000 rupees a ton, so it should be 100 rupees, 500 rupees. Why it is so? Now this guy will say, then you have to buy minimum economic quantity, meaning you have to buy a whole container full of plastic granules, that is 1000 kilo, 1 ton. So if you buy 1 ton, then I'm going to sell you at 1000 rupees. But if you buy 500 kilogram, I have to break a container and then give you half the container in a separate container or whatever that is bag. So my transportation cost is high, whereas I can transport full 1 ton in a rickshaw or in a trolley, but I have to now incur cost twice. So your cost will come up. So that is what is inventory management. And why I'm here, cost classification, whatever that is. So all these are places where you can leverage, meaning you can have a handle on reducing cost. So if you buy in bulk quantity, you reduce the cost through price itself, mean the price directly goes down. But with reduction of price, with this economic quantity, minimum economic quantity, your requirement of money goes up, meaning that you need more money to buy 1 container full of raw material. Now you have to make a trade-off between the two and see which is better, to buy 500 rupees without borrowing any money, or to buy 1000 kilogram by borrowing some money from the bank. So if you see that buying higher quantity makes sense, then you should buy higher quantity. If nothing, it gives you comfort that I have my raw material ready. I'm not going to run out of raw material, and if there is any strike, unrest somewhere, transportation dislocation, at least you have the material. At the same time, you should also remember that higher amount of raw material will require higher area for storing them. So everything together is a holistic decision. Every decision is has to be a holistic decision. Otherwise, it will end up incurring more cost while you are actually trying to reduce the cost. Now, cost can be classified for break-even point analysis and for many other analysis, particularly costing analysis. You need to classify them into different categories. Like for cost analysis, you need to separate direct cost and indirect cost. I'll just put it here. This is for costing, and this is for what? Oh, sorry, put it here and I forgot. This is for break-even point analysis. So this is very important actually, this distinction. I don't know why I did not keep in mind while delivering lectures earlier. See, when you do a product costing, there are complex situations. Let me elaborate that, then you will appreciate. Suppose you are manufacturing pen, same pen, low cost pen, and you are also manufacturing a very high cost pen. Okay, say you are manufacturing a pen that will be sold for 5 rupees, and you are manufacturing another pen that will be sold for 100 rupees. Now suppose the rent in this plant, for premises is say hypothetically say 1 lakh rupees a month, hypothetically, just to accentuate or whatever adjective you use the situation, so that you appreciate it better. Now suppose you are selling 1 lakh pen a day, so no, 1 lakh pen a month, you are selling 1 lakh pen a month, but the high cost pen is sold only 1000, and the low cost pen you are selling 99,000. Now if you allocate the rent on an average basis, you are paying a rent of 1 lakh rupees. Now you are selling 1 lakh pen, so rent per pen is 1 rupee. 1 lakh divided by 1 lakh. Rent per pen is 1 rupee. Now the pen that you are selling for 5 rupees, if you load a rent of 1 rupee there, that is going to increase the cost so drastically. Whereas you are selling the other pen for 100 rupees. Even if you charge 10 rupees of rent on that, it's not going to change it as drastically as it is going to change for 5 rupee pen. Get this idea. That is number one. Number two, for selling 100 rupee pen, you need more expertise, you need more attention, more polishing, etc., etc. That means even though the number of pens are only 1000, you are occupying maybe about 50% of the area of the premises. So that, or maybe it is in air conditioned room or something, whatever that is, if you are occupying 50% of the area, then the rent also should be allocated accordingly. 50% of the rent, not 100, not 99, sorry, not only 1%. If you make only an average estimate, like I am manufacturing 1 lakh pen, I am paying 1 lakh rupees of rent, that means per pen rent is 1 rupee, will be absolutely a suboptimum kind of estimation. And that is going to lead to higher pricing of your low cost pen, lower pricing of your high cost pen. Now you charge 10 rupees, meaning you come out of that, you determine rent based on, allocate rent based on area occupied or something. Suppose they are occupying 10% of the area, then you allocate 10% of the rent there, meaning 10,000 rupees is allocated for 1000 pens. That means 10 rupees is allocated on every pen. So the selling price will now be 110 rather than 100. Nobody is going to mind about that. People, when you buy a costly pen, you just see the price. If you see the price of one pen is 110, another pen is 100, you will have a tendency to think that 110 price is better. You will end up buying that because you are not so much price sensitive. This is called price inelasticity. Whereas for 5 rupees pen, if the price becomes 6 rupees, you want to buy a dozen of that, you are highly price sensitive. If you find another pen of 5 rupees, you will tend to buy the 5 rupee pen rather than 6 rupee pen. So eventually, this is how costing, meaning classification of costing, helps you to price differentiatively. Okay, that is for costing. Direct cost and indirect cost. Indirect cost is the rent, which you cannot identify in the pen, whereas plastic cost is a direct cost. I'm sorry, but that is indirect cost. Plastic cost is a direct cost that can be identified on the pen. See, if you look at the pen, you know that there is plastic that has gone into, that is the clip, metallic clip that has gone into, the nib that has gone into, the wing ink that is gone into. But when you have the pen in your pocket, you are a customer, you will not know how much rent the company has paid. You will not know how much plastic, but you have some idea. If you see two pens, you will know that, okay, this pen has this amount of plastic and this pen has that amount of plastic. But now you won't have any idea about the rent that they paid, the interest that they paid. Many of the expenses that they paid will not be identifiable in the pen. Those are indirect costs. Those costs will be allocated based on some proportionality of some system that I'm not going to discuss now, but direct cost will be allocated directly because you know how many grams of plastic this pen has consumed. Accordingly, you are going to cost it. Metallic clip, same is the refill. So you add up all of them which are directly available, which are directly identifiable. So that is how this direct cost and indirect cost are different, and to be able to cost judiciously, reasonably, rationally, you need to bifurcate the cost into direct and indirect. Whereas for break-even point analysis, as to when I am going to meet all the expenses that I am incurring by sales or in terms of sales, to understand that you bifurcate the cost into fixed and variable cost. Let me move forward first. Suppose you're manufacturing shirt, you are a darji and you're manufacturing shirt. You have the fabric available, so you know that this amount of cloth is necessary to manufacture one shirt, stitch one shirt. So you know how much cost is that involved, how many buttons, each button has a cost, how many buttons you have, how much of thread you are going to use, in labor, how much of labor hours will be involved. So all these are direct cost, and they actually vary. First of all, they are direct cost because you can identify when you look at a shirt, you know that there is some button cost, there is some thread cost, there is some cloth cost, and then you also know, looking at it, that somebody has modified this from a canvas into a shirt. So there is a labor cost, that is also direct cost. Now rent, depreciation, salary to permanent staff. You do not know how many accountants are there. Interest on fixed capital, maintenance, insurance. These are all indirect cost, and this is direct and indirect, and they are all cost drivers. Now, if you want to understand fixed and variable, fixed costs are those costs that does not change with the level of production. For example, here you are manufacturing one shirt. One shirt will require certain amount of cloth, certain number of buttons, certain amount of thread, certain labor hours. If you want to manufacture two shirts, that is going to require double that, exactly double. There is no compromise on that. Whereas if you're manufacturing one shirt, you are paying certain rent for the premises. If you manufacture two shirts, you are going to pay the same rent, not per shirt, per annum, per month. You're going to pay the same rent. You're going to pay the same depreciation. You're going to pay the same amount of salary to your accounting staff, irrespective of how many shirts you are making. If you are making 1 million shirts in the same premises without making any change, the rent is going to be same on a monthly basis. So on a per shirt basis, that is going to be very minimum. But then on a monthly basis, your cost is fixed. That is why these are fixed cost. And on the right side, these are variable cost, because that varies. The cost that varies with the level of production are variable cost. The number of buttons varies with the number of shirts that you produce. So that is variable cost. I have already defined this. Now you should be mindful about one more thing. That is, nothing much is there here, but know that you incur so many types of costs, maybe sometimes 100 types of cost, but all the cost is to be met out of sales. Sales is the only inflow, cash inflow. Sales is the only cash inflow. All are cash outflow. There may be exception, like you sell a machine, old machine, that brings you cash. True, but that is not your business. That is an exception. Whereas whatever you incur, whatever on a daily basis, you will see that every time you issue a check, these are all cost is going out. Only one stream, that is sales, that is coming in. Now these red lines are all different cost element, and the x-axis is the volume that you produce. So if you produce 0 unit, all the costs are 0. If you produce say 10 units, so every cost will be multiplied by 10. Sorry, if you produce 1 unit, every cost will have unit manufacturing cost, unit product, whatever cost. Now you manufacture 10 units, 10 times of that will be involved. 5,000 unit, 5,000 multiplied by cost of 1 unit will be involved. That is how variable cost changes. So the total, if you add up everything, this is perhaps the variable cost. This green line is the variable cost. It starts from 0. It is not 0 here. It should be ideally, it should ideally start from 0, because when you manufacture nothing, there is no cost. Manufacture 1 unit, there is some cost. As you manufacture increasingly higher amount, then your variable cost goes up. Now look at this blue rectangle. Look at the blue rectangle. This is fixed cost, meaning that this includes rent, includes depreciation, includes interest on fixed capital, includes administrative expenses. Whether you manufacture anything or not, administrative expenses will remain administrative expenses. You have to incur that. So at 0, it is something. Even at 5,000, it is the same thing. So fixed costs remain fixed irrespective of the volume that you produce. This side y-axis is the cost. So when you are incurring fixed cost or variable cost, y-axis will tell you what is the value. At the same time, suppose this is a total cost line. Okay, red is the cost, and suppose this is your sales. The green is the sales. So red is the total variable cost, green is the sales. So this is how sales curve is increasing, and this is how the variable cost line would look like. Now, if you are thinking in terms of total cost, then variable cost plus fixed cost is the total cost. So this line will go here. This is the total cost line. At 0, there is no variable cost, but the fixed cost remain fixed. At this point, say here, at say 5,000 or something, your fixed cost remains the same, whereas your variable cost increases, and this is the total cost. This is the total cost. Now, and this is sales. So sales actually should have a higher slope, should be like this. I drew it just like that. So sales line is like this. Sales starts from 0 because when you sell no product, your sales is 0. You produce and sell one product, 1 unit, sales become something. You produce and sell 5,000 unit, sale will be something different. So try to extrapolate that up to here. Okay, so it will be something like this. Wherever this sales and put some other color. Wherever this meets, wherever this two line intersects, meaning the sales line intersects with the total cost line, total cost, both variable and fixed. This is known as break-even point, meaning at this point your sales is whatever is your sales in terms of this line, say at this point, this is the sales volume, sales in rupee, this is the volume, and this is the sales in rupee. It intersect here. This is the break-even quantity, and this is the break-even sales in terms of rupees. And this is the total cost as well. This is the total cost as well, because here total cost and sales are the same. Okay. Okay, so let's move forward. So this is how the break-even actually is the philosophy of the break-even point. Now, why separating the cost into fixed and variable? This we are coming. Suppose you are starting a ready-made garment business. So you're going to make some ladies garment, some men's garment, and maybe something more. So what you need to pay rent, you need to buy machinery, and then other accessories like an iron, like many other things. These are fixed cost. Fixed cost, not fixed expenses. Fixed expenses is different. These are fixed costs from balance sheet point of view. Now, your fixed expenses, I should have written expenses. Rent paid for the building is 12,000, 1,20,000 rupees in a year. In a year, for a full year, rent is paid 1,20,000. You pay depreciation for all the machineries, fixed assets. These are fixed assets. I'm sorry. These are fixed assets. So for fixed asset, you pay depreciation. You don't pay cash, but you have to show that we are paying because you are using up part of the machineries. So that is you are apportioning, or the amount that you use up, you pay as depreciation. Administrating overhead, this is also fixed cost because this never changes. Whether your plant is shut down or operational, or it is running at 2 times the installed capacity, it will remain the same. Total fixed cost is 5 lakh rupees plus 15,000 rupees plus 1,20,000, that means 635. Fixed costs are mostly those which are paid periodically, meaning on a monthly basis you pay rent, on a monthly basis you pay salary to say regular staff, permanent staff. Depreciation is estimated on an annual basis, rent is paid on an annual basis or monthly basis, meaning on a periodic basis. However, costs such as electricity bill, telephone bill, and other utilities, even though it is paid periodically, you actually consume on a daily basis. So these are not fixed costs. These are variable cost. Material variable cost because it depends on number of unit. Look at this: one shirt, certain amount of cloth, and certain number of buttons, certain amount of thread, and some labor cost. This is the total cost for one shirt. These are the total variable cost. Total is 530 rupees. Look at, if you multiply this shirt, what happens? You want to manufacture 2 shirts. The cost will be 530 multiplied by 2 because the same labor, same cloth, same button, same thread. You want to manufacture 16 shirts. So eventually you have to spend 16 times 5 and 30. These are all variable costs. They are changing with the number of shirts that you produce. Okay. Now, that is why the salary that you pay to a labor who is a permanent staff is a fixed cost. Whereas suppose you hire somebody on contractual basis, that number of shirts you manufacture or stitch, your payment will be commensurate with that, proportional to the number of shirts that you stitch. So that becomes a variable cost because it varies with number of shirts. Electricity, it varies with number of shirts. Maintenance varies with number of shirts. Sometimes it may be fixed, but we shall always consider it as variable. So whenever there is a sum, you consider maintenance cost as variable. I'm not increasing complexity. Similarly, insurance, this may be variable and there may be fixed, but we will consider this as variable cost. Interest has 2 components, and I'll definitely bifurcate. I'll not mix them. If there is a term loan from bank, long-term loan, that remains fixed for as long as you don't repay. So interest on that is fixed. Whereas working capital that you borrow for maintaining inventory, that changes with level of production. So that remains variable. So that is variable cost. Consumable, like say thread, like chains, like many other things. These are termed as consumables in accounting term. They vary directly with number of things that you produce. So that will be variable cost. Then packaging. If you package 1 shirt, you need certain amount of money. If you package 100 shirts, you need exactly 100 times that. Even though there may be economy of scale, but we don't consider it there. We just multiply. So this is variable cost. Now let us see what is the total variable cost that you have already shown, 575, including transportation. So any cost that can be identified on the product, etc., I said using formula. You can use a formula to estimate what is the break-even point. We start from profit. Profit is sales minus all the cost. So cost may be fixed cost and variable cost. Now assume that selling price is S and quantity sold is Q and total profit is P. Then you get sales is equal to Q into S. Q is the number of quantity, S is the selling price. Variable cost is Q into V. Q is the total quantity, V is unit variable cost. Total cost is total variable cost plus total fixed cost. F is total fixed cost. It does not depend on number of unit. That is why F into Q is not there. F itself is annual cost. So now what is profit? Profit is sales minus total cost. Total cost is Q into V minus F. So it came here, and this is total sales, Q into S. So that is how this formula came. And from here, you estimate Q is equal to F plus P divided by S minus V. F is fixed cost, P is the profit, S is the selling price, V is the variable cost. Unit variable cost. These are all in units. This is targeted profit. Okay. So quantity to be produced and sold to break even. At that point, there is no profit. Profit is equal to 0 to get break even point of quantity. That is why I start. Now, if you put this formula, P is equal to 0. So P vanishes. Q is equal to fixed cost divided by selling price minus unit variable cost. Selling price minus unit variable cost. Now, selling price minus unit variable cost is a very important metric. It is used extensively. In fact, in the next class test, there is a question on contribution margin. So you better understand what is contribution margin. Contribution margin is nothing but selling price per unit minus variable cost per unit. Why that is important? Now we can replace this formula by saying Q star is equal to F divided by contribution margin. Fixed cost divided by contribution margin. Why the term margin? Because it is per unit basis. Total sales minus total variable cost is equal to total contribution, not margin. Contribution for the year. Contribution margin, just for another explanation, selling price is 800, variable cost is 575. So contribution margin is equal to 800 minus 575 is equal to 225. As simple as that. If you are manufacturing n number of shirts, the total contribution will be 225 multiplied by n. Okay. Now an example of break-even point. Suppose selling price is 800 rupees per shirt, variable cost is 575 that we have seen, fixed cost we have seen at 6,35,000. So you plan to produce 5,000 unit. We want to know whether you're making a profit or you are incurring a loss. To know that, we have to estimate the break-even point. Break-even point quantity is equal to fixed cost, which is this F divided by selling price minus variable cost. Selling price is 800 rupees, variable cost is 575 is equal to 2822. Ignore the decimal, but before ignoring, you have to add 1 here. Why? Because you cannot have 0.22 number of shirts. At the same time, this is number of shirts that you have to produce to break even. 2,822.22 number of shirts have to be produced to break even. Now you are producing 5,000 units. That is your plan. So obviously you are making profit because at 2,822.22 you recover all the expenses. Now whatever is the contribution margin, that will be translated into profit. Before we move on, let me tell you, there cannot be 2,822.22 shirts. So what you should do is, you should make it is equal to 2823, because if you manufacture 2822, you are not going to break even. You have to accept 2823 shirts only to manufacture. Okay, now contribution margin revisited. S minus V, selling price minus variable cost is contribution margin. Now contribution from unit product is selling price minus unit variable cost. Total contribution is total sales minus total variable cost. Now the same example, your break-even point is 2228, but you have to make it 2823. So this is fixed cost. showing it graphically. This is fixed cost, this is variable cost, and this is total cost, because variable cost moves here and becomes total cost. This is sales.
Sir.
Hello?
Hello, sir.
Any question?
Yes, sir. In the previous example you have said, can you explain it again, sir? How did he get profit?
Okay. Okay, I'm coming there. See, your break-even point is 2822. That means if you manufacture and sell 2822 units, you recover all the expenses. Now, if you manufacture any more unit, come here. If you manufacture, see this gap between these two lines are the loss. At this point, this is the total cost line. At this point, this is the total cost line. So suppose you are manufacturing, say this is suppose this is 50 units, 50 shirts. Okay. So for 50 shirts, your manufacturing cost is this. Okay. Whereas your revenue or sales is only this. Try to understand. You get the point? Your sales is this line. Sales is this line. So at this volume, wherever your sales line crosses here is the sales. So you are selling this maybe something like say 1000 rupees, or sorry, not 1000. Say this is 10. So this is 8800 rupees of sales, whereas your expenses is much more. Now when you break even, your total cost and total sales are the same. Okay, this is the sales line, total sales is this. This is the cost line, total cost is this. So sales and cost are the same. Let me put some value. That will take time. Actually, I wanted to cover more. ठीक है, कोई बात नहीं. I'll make it more clear, because making it clearer is more important than anything else. Now, suppose at this line, at break-even point, what is your total variable cost? Can you tell me? Can you tell me what is the total variable cost?
575 rupees.
Just a second. Sorry. Yeah. See, your unit variable cost is how much?
575 rupees.
575 into 2823 is the total variable cost. 16,23,000. What is the fixed cost? Plus 6,35,000. This is the total cost for manufacturing 2,823 shirts. Is this clear? Is this clear? See, for one shirt, you incur 575 rupees of variable cost, and you incur 6,35,000 rupees of fixed cost. This fixed cost is always fixed, no matter how many you produce.
Yes, sir.
Now, when you produce 2,823 shirts, what will be the total cost? The total cost, let me write it here. The total cost
22,58,000, sir.
Is equal to, first of all, 2823 multiplied by 575, plus you have to incur 6,35,000. What did you say that is?
22,58,225. 58,225.
Yeah, so this is the total cost. How much is the sales? Total sales is equal to how many you have sold? 2823, right? What is the selling price? 800 rupees, right? How much? Multiply.
22,58,400.
22,58,400. Look at the data. This is almost, this is your sales and this is the break even. It is not full number because it is a fraction. That is why this amount is slightly more. Had it been this, suppose it is not 23 but 2.22. How much is this estimate? How much? Much?
22 lakhs
22 lakhs
57,776, sir.
225.
57,776, sir.
No,
22 lakhs
that's not
57,700.
that can't be. There's some mistake. Just a second. Let me do it.
Then in total
28.
cost we will also take na
In total cost,
22.2.
Oh, right. Right. Thank you. Yeah, you have pointed out the right thing. Here also it should be 2.22. Then you will find these two are same, which is coming graphically here. This total cost and sales are same. That is how this graph has been plotted. Okay, so here you can see that the total cost, this is variable cost, this is total cost, this is sales, and wherever they are intersecting, this is the loss zone, this is the profit zone. Now you manufacture another unit more. After 2823, if you manufacture one more unit, this is very important. You are going to make a profit of how much, you know? You are going to make a profit of exactly 800 minus 575, because this cost has already been recovered. Now this cost is no longer to be recovered. This is absolutely recovered. Whatever is the contribution margin, that will be the profit per additional unit of sales. Whatever is the contribution margin, see, this difference is the variable cost and sales difference between variable cost and sales. Whereas here the difference was different. Here the difference is fixed cost plus little bit of variable cost. Here also the fixed cost, little bit of variable cost. Whereas here the difference is only the contribution margin. So additional profit for any additional unit is equal to the contribution margin. So this is to be understood very thoroughly. Margin of safety. Just I'll finish it off in a minute and then we'll call it quit. See, you are planning to manufacture 5,000 units. Even though your break even is at 2823, break even is 2823, but you are planning to manufacture 5,000 unit. So you are going to make profit. Now, whatever additional unit you are manufacturing beyond break even point is the margin of safety. So here the margin of safety is 5,000 minus 2823 is equal to 2177. That is what is margin of safety. So graphically speaking, this is the margin of safety. Beyond 2823, you are manufacturing 5,000 unit. That is margin of safety. I think we'll not move further. I have already crossed the time. So thank you very much. If you have question, you can stay back and I can clarify. Otherwise, thank you. Let me stop recording.